Hi, my name is Marcus.
My name is Philip.
My name is Brad.
And together, we will explore how to interpret an income statement from the sales revenue down to the profit for the year made by a company.
In this tutorial, we'll be using our latest income statement from our company MBP Limited.
Starting with the first line on the income statement, we see MBP's sales revenue. This first position is also often referred to as total sales, total revenue, or gross sales. The sales revenue accumulated over the entire accounting period. Therefore, the sales revenue is the sum total of all the products sold by MBP in the calendar year of 2018, for example. In the case of MBP, the sales equals 233,000 euros.
The cost of sales or the cost of revenue, those terms can be used interchangeably, represent the expenses the company has paid in order to manufacture, source and deliver a product or service to the end customer. In our case, the cost of goods sold is 154,000 euros.
The next item is the gross profit. The gross profit can only be determined after the total sales and the total cost of goods have been calculated. To calculate the gross profit, you subtract the total cost of goods from the total sales made. In our case, the MBP financial income statement, the total sales is represented as the sales revenue, which is 232,000. And the total cost of goods, which is the cost of sales on the MBP's financial statement, is 154,000. And when you subtract 154,000 from 232,000, then you have 78,000 as the gross profit. Why is the gross profit important to any company? The gross profit helps to determine if a company is making profit over expenses. In this way, the company will be able to attract creditors and investors. When a company has a negative gross profit, then it passes a message to the investors and the creditors that the company is not sustainable.
So let's look at operating expenses. Expenses are the opposite of revenue. They represent the outflow of economic benefits arising from the ordinary operations of business. While the revenue and COGS positions of an income statement look pretty much the same across all income statements and across all industries and companies, the breakdown of operating expenses may be presented in very different ways. As you can see at MBP, operating expenses include salaries, rent, energy costs, marketing, communications, running expenses, and so on. Here, these items are simply listed, which is absolutely fine. On many income statements, however, different types of operating expenses are clustered together under informative headings. A popular approach is to differentiate between selling, general and administrative costs, non-recurring costs, and other expenses. So let's start with the SG&A, the sales, general and administrative costs. They are incurred by every company. And according to Devin Pickle at Team G2, they cover all major expenses outside the direct development of a product or service. These essentially include the staff keeping the business side of things running and going. In addition to the wages and other employee costs, the selling, general and administrative expenses cluster also lists expenses for office supplies, computers, rent, utilities, company-wide softwares, etc. SG&A are usually the largest operating expense in an income statement.
For MBP, this amounts to 53,400.
And that's the 78,000 minus the 24,600.
For the depreciation, a company must factor in the depreciation of equipment used in the production cycle. It's up to the company to decide if they'd like to write off the value of the expenses right away or over a life cycle. Many business owners prefer the latter, which reflects better on the future income. So let's have a look at an example. MBP, our company, buys a machine for 10,000 euros. That machine has a life cycle of, let's say, 5 years. That would mean that the company would deduct 2,000 euros, so 20% of the machine each year. Next, amortization. Amortization is the allocation of costs to pay off intangible assets over time. Hence, amortization is the flip side of depreciation for intangible assets such as bank loans or goodwill. After that, we arrive at the operating profit. This represents the wealth generated during the period after all operating expenses have been deducted from the revenue operations. Finance expenses are not included. In MBP's case, the operating profit is 24,600 euros.
The next on the list is the profit before taxation. The profit before taxation is derived by adding the interest received from investments and subtracting the interest paid on borrowings. In the case of MBP, the interest received from investments is 2,000 euro, while the interest paid on borrowings is 1,100 euro. When you add up 2,000 euro and subtract 1,100 euro, we arrive at 25,500 euro as the profit before taxation. The next on the financial income statement list is corporate tax. Before we calculate the profit for the year for the company, a company has to pay the corporate tax. Now, because MBP is located in Austria, we will be using the Austria taxation system, which is 25%. And this differs from country to country. So, 25% of the profit before taxation would be 6,375 euro. To calculate the profit for the year, the corporate tax, which is 25%, is deducted from the income before tax. In MBP's case, 25% will be 6,375, deducted from 25,500, which will leave us with 19,125 as the profit for the year.
To sum up, it is very important to understand your income statement thoroughly. As we said, the income statement starts with the sales revenue minus the cost of goods sold, which equals the gross profit. After that, the operating expenses are deducted, plus depreciation and amortization, which equals the operational profit. After that again, financial expenses are deducted, which equals the profit before taxation. Lastly, taxation is deducted, corporate tax, income tax, and you have your result of the year, the profit of the year. Generally said, know your numbers, own your business. Thanks for your attention.